Yeah, today is a really interesting webinar, I think, especially for our prospects and clients in the CPG industry. One on private labels. That is, of course, quite a pressing issue at the moment with inflation. Is it going up? Is it going down? But definitely private labels have become ever more important. We'll see some statistics on that, how true that is for some markets and others. And today's webinar will be definitely quite interesting for everyone in the space. Anyone who works for brands that are under pressure from private labels or that fear private labels being more important, and now with inflation taking the next level. And yeah, I'll do a quick intro from our end on the speaker today. We have here Ingo, our co-founder and managing director at Buynomics, over 13 years experience in pricing. He also developed the Buynomics method, which we will also showcase here a little bit. And I'm Paul, I'm leading the sales team at Buynomics, and I will be kind of moderating the session. If you have any questions, please send them in the chat or in the Q&A. We'll also clarify that there and then. Maybe quick word on what Buynomics does. So Buynomics is a cloud software for pricing and revenue management teams. We have a new approach, which I alluded to with the Buynomics method, that makes it much more easy to have a holistic understanding of market dynamics, especially in these dynamic times. It's quite important to always be on top of things, have your always on solution ready, to be more proactive and have everything come from a single source of truth. So that's what we do, and we'll see that a little bit in this session today. But I'll hand over to you, Ingo, to get us kicked off on the content, and I'll be writing in the comments for anyone interested in asking any questions.
Yeah, thanks Paul for the intro, and thanks everyone for joining to this webinar today. I think we have an interesting topic, and I think something where we also have quite something to contribute when we go into the details. I think that should become obvious. So what we want to do today is just start off with a little bit of background essentially on the topic. When we talk about pricing, revenue management, just a quick reminder of what we mean by that. I hope it matches to your understanding. If not, please write it into the comments. Happy to discuss this towards the end of this webinar. We'll just give, as Paul mentioned, just a little bit of background on private labels. And I think where we can contribute most is when it's then really about the dynamics, understanding how things like price elasticity, interdependence, substitution between products, and so on affect decisions, and how to best work with the specific dynamics of a category to improve the own position, depending on what the specific goals are that everyone follows, be it profit maximization, market share maximization, or market share increase, or something like revenue maximization. So this is really what we'll be talking about. And before we do that, just a little bit of context. So when we speak about pricing or revenue management, we mean, of course, all the different levers. So working with, when we look at this, that category here, where we have, as an example, different chocolate bars, we're interested in how the individual products are priced, what the architecture is, so what different types of products and sizes we have in our portfolio, how we work with promotions. Do we have at all promotions? Do we have something like 2 for 1? Do we give a discount? Do we combine it with other measures, and so on? So everything that is included in here, mixed management, how we steer across different channels, and also how we work with that in terms of trade terms. And of course, to best work with these levers, it makes a lot of sense, and we'll show what that means to work with them all together. What we see often, that these are being attacked or approached in sequence, but what, from our understanding, and I think with the technology now available, we can discuss all of these at the same time, and this should typically produce better results than doing each after the other. All right, just a just a reminder, essentially what we're talking about. I think most of you are, if you're working in the field, are aware of the fact that the share of private labels is increasing over time. Private labels being products typically introduced by retailers with their own brand and typically priced at the lower end of the portfolio. There are lots of variations, of course. Some retailers have multiple private label brands, some have just a single one, but essentially it's these labels that are introduced by retailers and typically positioned at the lower, in terms of price, at the lower end of the market. And we see, when we look at the whole globe, a large variation with, particularly in Europe, a massive amount of private labels, and then going down to America, the North Americans around 14-15%, going down to Latin America with just 2%. So the importance of private labels varies largely across the globe. And also, just to conclude this, within Europe, we see large differences, with the largest share being in Switzerland. Of course, this probably has something to do with the fact that Switzerland overall has a very high price level compared to surrounding neighboring markets. But we see that there's a huge range, and importance of private labels across different countries. And I think what makes the topic of private labels particularly pressing right now is, of course, the fact that we've seen large inflation, particularly last year, or towards the second half of last year. I think the latest numbers, I think yesterday, 2 days ago, in the US, we had the news that essentially inflation is slowing down, in some areas already reverting, so prices going down in some parts. So I think the overall topic is still massively relevant, inflation, but it looks like, particularly at the moment, that it's at least slowing down a bit. And I think for us, it's important, and the way we at Buynomics think about inflation is essentially in different phases, how it develops, and different countries are also in different phases. So typically, when what we saw last year, a country comes from an area where there has been close to 0% inflation, you see that the first things that happen is that you have you have cost increases, the COGS increase. Because of that, companies, competitors, everyone increase their prices. Typically in this early phase, willingness to pay, customers' preferences have not yet changed or adapted to the situation, and they react to the increased prices essentially with their existing demand function. So if you happen to be the only one increasing prices, you typically experience a large price elasticity. Whereas when everyone is increasing prices because all the competitors have similar increases in their cost, then the actual elasticity is typically much lower. So this is what initially happens. And then after a time, when customers also get used to or adjust to the inflation, you see something like sector shifts, where customers reduce, for example, their spending in categories where they don't have to spend. So their discretionary spending go down, they adapt to that. So you have these shifts between sectors. Some sectors benefit from that, some are hurt by it. And we also see some behavior changes, for example, that customers pay more attention to these private labels. And this is also one of the effects that leads to a recent increase in the share of private labels. What we then see typically in the long run, and this is something you see in countries to some extent in Latin America, Turkey, for example, where you have persistent inflation, is that essentially the whole system gets used to it. You see that companies have more frequent price changes, which makes sure or supports the persistence in inflation. And you also have an ongoing change in consumers' willingness to pay, because, for example, their wages increase, and then you have this vicious circle where inflation is persistent. It's really difficult for an economy to get this circle to stop. So these are the ways in which Buynomics think about inflation. It has a massive impact on how to work with inflation, how to model it. So in this initial phase, you don't have changes in like essentially your demand curves or your willingness to pay. And at some point you see these shifts. And this is also something that's been picked up in sales data, for example, or in surveys or any way in which companies monitor customer behavior. So this is important to know. This is I would say the context in which we're talking about private labels. And let's start with a simple example of private labels to just get an understanding of the basic dynamics in terms of pricing. And we put up here the factors or the drivers that we consider particularly important. If you think there's something missing or you think that something else is relevant, please let us know. Happy to discuss at the end. So let's start with a very simple example. So there's one branded product and there's one private label product. The branded product is a bit more expensive. It sells at €1, the private label at 50 cents, and they have both about 50% market share. And we're now interested in what happens if, because of inflation, cost increases, we both, maybe just one of us or both of us, have to increase the prices. And I think what's relevant here are essentially three things. The way in which COGS increase. So for example, are cost increases proportional to the existing costs, or are they an absolute increase in the euro cent in this case here in terms of the cost? How do price elasticities differ? Do the branded products and the private label products have similar price elasticities, or do they differ? Maybe you have a strong brand with a much lower elasticity, or you have a private label which has a lower elasticity because it's priced at a much lower price point. So there can be, or there typically are differences. We'll see that in the example that we'll look at. And I think the third very important point is the interdependence between the products. So do we have products that are largely independent? So if I sell more of the branded product, does this affect sales in the private label and vice versa? Or do we essentially have more or less a zero-sum game where gains by one always are losses by the other? So these are the three important things to consider in the first instance when we want to understand how to price relative to private labels. And let's look in these in sequence. Just a little bit of theory here. So we'll be working for this example with essentially a very simple price demand function. So we have our sales volume, we have our price, and we have an exponential demand curve. This is convenient because then our price elasticity is always the same, doesn't depend on the price level. It's of course different if we have a linear demand function, then price elasticity changes when we change the price, but here just as an assumption, it's always the same. And what's the right thing to do if you are in the profit optimum? What you should do is if you have a 10% price increase, you should also increase, if you have a 10% cost increase, you should also increase your price by 10%. So that's the profit optimal behavior. And let's look at a simple example, the one we had on the previous page. So we have our branded product selling at €1 with COGS of 50 cents. So we have a 50% margin, which is the profit optimal price if we have a price elasticity of -2. And the same is true for the private label product, COGS of 25 cents, the price of 50 cents, also market share of 50% in terms of unit sales, elasticity is -2. So it's the same for both of us. And now we have a COGS increase. In the first case, it's proportional. So our COGS increased by 20%. And also the private label COGS increased by 20%. So they go up from 50 to 60 and from 25 to 30. And we want to stay, both of them want to stay in the profit optimum. So the branded product goes to 120 and the private label product goes to 60 cents. Because of this 20% up and you have a price elasticity of -2, you lose 40% in sales. So they go from 10,000 to 6,000, but the market shares remain the same as we would expect. pretty much doing the same thing. We don't depend on each other. That's always, and it's important to note, I think also for everyone's practical work, if you work with product level elasticity, and in everything I've seen where this is done, where, for example, you get from an agency price elasticities, the implicit assumption is always that everything is independent. So the price change of the private label product never affects anything else going on. So this is really, if you work with elasticities, sort of implicitly assuming that there's no interdependence between these cases. And this is also what we're assuming here. As an alternative, so when we have absolutely the same COGS increase, so it's 5 cents in each case, and we do the same computation, we see that in percent here, the optimal price change is only half of what it is here. So we go from €1 to €1.10, and here from 50 cents to 60 cents. We see that the branded product gains 7% in market share, goes from 50 to 57, and the private label goes from 50 to 43. So in this case, an absolute cost increase leads to a gain in the market share of the product. And this is already, I think, an important topic, because we're seeing in the customers that we're working with, where we see that data, that there is a wide range of cases how COGS increases are affecting at least the own portfolio. And there's a range where the cost increase is more absolute. For example, if you have the branded product and the private label product, logistics costs are, for example, very similar in absolute terms, because the transportation doesn't really depend on the value of the product. So there are, whereas some other cost increases are more proportional. And this is something that's important to understand when dealing with these situations and how to relate to the private label products. How cost increases happen in markets? Are they more absolute, comparable, or are they more proportional between the two cases? So this is the first thing that's important. And the next thing that's important, of course, do we have similar or different price elasticities? Just make one small correction here. All right, so in this case, we have in the first one, we have a lower price elasticity of the private label product. So it's only 1.5. In the previous example, it was 2.0 in both cases. The branded product is still the same. Price elasticity for the private label product is lower. And this can happen. This is very often the case because it's just selling at a lower price point. And this often leads to a lower price elasticity. So this can happen. And in this case, of course, the private label product gains if both increase prices at the same percentage rate, and vice versa. If the branded product has a lower elasticity, of course, it gains market share. And this can also happen, for example, in cases where you have a very strong brand, a very high willingness to pay for the branded product. High willingness to pay tends to reduce the price elasticity, or if not in this case, but in more realistic cases, here we're only looking at a single product. But if we have a large portfolio in its totality also reduces the price elasticity, because lots of customers, when they switch because of an increase in price, stay within the portfolio and buy a different product from the own portfolio. So there are different things that can be done to reduce essentially the price elasticity, building brand value, and also having a broader and more differentiated product that, comparable to a net, essentially captures more of the lost sales in one product. All right, so these are the first two. And essentially, when you work with price elasticities, this is what you can do, but you cannot really look at interdependencies, because at least I've never seen this in practice. Cross elasticities working in a way that it really makes sense for practical tasks. So, but this is particularly when we talk about the relationships to private labels, an important concept. And just to highlight this, so we have, again, as before, our branded product, we have a private label product. And in the case of low substitution between them, the aggregated demand of the two products pretty much looks like the aggregate each individual demand. So if you increase prices, the sales volume goes down, just as each individual product sales volume goes down. If, however, you have a category with high substitution, so that the total demand, for example, toilet paper, butter, many of the categories with a high necessity, where also the usage of the product doesn't really depend on how much you paid for it. In these cases, the total market elasticity is very, very low, as you can see highlighted here in this graph. So if you increase the price of all the products or just one of the products, the total demand is fairly stable, because customers then switch between products, and in this case, they switch between branded products and private label products. So, and this distinction is really, really important for many things, and the way you look at the relationship between branded products and private labels. This has a lot of effect, because in the high substitution case, really everything the private label product gains, some brand product loses, whereas in the other case, they're much more interdependent. And of course, in reality, you don't have these clear cases either or, but it's more like a sliding shift between the two. But it's important to understand where you are in the category between these two extremes. And I just want to show you what I mean in a simple example. And Paul, can you tell me when you see my browser?
Yes, I can see it.
Okay, perfect. So just move this. All right, so here's a very simple example, similar to the initial case that we showed with the two products. In a minute, we'll also look at a more realistic example, but I think this is more useful initially to highlight the main idea. So we have these two products. We have the branded product. So we have here the brand name, whatever it is, and we have here the private label. We could have different sizes, but for this example, we're just using the same size for everything. We have, as before, we have costs, 50 cents, 25 cents. We're selling at €1.40, and we can essentially look at different price points for this product. And then what we're interested in is to understand how many units we sell at different prices, and also how these two products interact with each other. So let's start with a simple case. So we increase the price here from €1 to €1.05. And we see that we have a very high elasticity, minus 3.3 in this case. And we are in a case where we have low interdependence between the product. It's not zero, but you'll see in a second what I mean. They don't interact too much. And this is also seen when I increase both. Elasticity goes down of the products, but it's still fairly high overall. So these are the cases. And just to conclude, just to give more context here, you see here the individual demand functions, similar to what we have seen before. You see that the private label product can massively increase at low price points, but at some point, particularly when it gets closer to the branded product, no one will buy it anymore. And we see that both can increase revenue if they wanted to, and also they are, which in a Nash equilibrium type situation, two products, everyone should be a little bit too expensive compared to the individual profit optimum here. And we see that elasticity, as I mentioned before, it goes down. The products become more elastic as the price goes up here. So this is the situation we're in. And what I mean with low interdependence is essentially this situation. So we have this Sankey graph here, and we can have the situation before the change and the situation after the change. And what I see if I increase both products by 5 cents is that we have both of them losing some sales, lots of customers who now buy nothing and don't buy either product. And let's say we increase this more, so then the other, we see that there are some customers that move from the branded product to the private label product. So there's little interaction. Typically there's not zero interaction, but there's very low interaction. If I now switch to a case very similar, let me just show this first. So we have here a case with high interaction, and we have, again, high elasticity, even a little bit higher than before for this product. But when I increase both product prices, you see that the elasticity already goes down very much. That means that the total sales in the category is fairly stable. And in these cases, if we show the details here, we see that there's much more interaction between the products if I increase the branded product more in price than the other. So we have lots of people going from the branded product to the private label. If I did it the other way around, it would be the other way around. So there's lots of interaction, and these cases with lots of interaction are, I would say, like more like the zero-sum games, where everything that one party loses is gained by the other, and all these strategic considerations become relevant. Do I want to gain market share at the expense of the other, or how do I manage the relationship with my partner, not with my partner, but with my competitor here in forms of the private label. So these are just two simple examples just to highlight the mechanics. And of course, you can essentially do the same with a realistic example. So this is anonymized, of course, but it's based on a real example. Let's say it's a soft drinks category. We have two own brands. Then there are two private label products here in the market and a bunch of other branded competitors. And we can, of course, do all the same analyses. No, not in these toy examples that we had before, but we can do the same in a real example. I put, just for this example here, also costs for the competitors. Of course, in reality, you don't really know that, or you have to work with assumptions, but you can really use something like this to understand the full dynamics in the market. And in real examples, of course, it's all a bit more complicated and nuanced than in these toy examples, but you can essentially do the same stuff, right? So we look at the price change, we increase the price of the product, we see a rather high elasticity here again for this product. It goes down if we also increase the price of our own other product. And when, as in this case, also the two private label products increase, we see that their elasticity is very, very low in this case, but because they are so large in their market share, in this case, they also reduce our own elasticity. And also we lose more share than the private label brands here in this case. We see that if they also increase prices, that the price increase is profitable for us in this case. So these are the types of dynamics. And looking at the clock, we're coming to the end of the half hour. You see that with something like this, you can analyze the dynamics, not just in these very simplified toy examples with two products, but you can do the whole thing with a realistic case. So here with roughly 10 products and the full dynamics you get. For example, in our solution, you can also do this, of course, on a weekly basis, on a retailer basis, and then use it to understand really what works best in each specific case. But I think what's important, and I'll go back to the presentation, what's important is to have an understanding of the principal dynamics of the relationship between the branded product and the private labels. And then for actual decision making, it's really important to have an understanding and the implications of the specifics that happen in the market. And just to summarize, so we looked at these different factors, particularly how COGS increase in different markets, how price elasticities may differ between the branded products and the private labels, and also the dependence between, in this case, the branded products and the private labels. Really important. Is it that they are largely independent, and in this case, you don't really have to worry too much about the private label, or is it more like a zero-sum game where everything the private labels gain, branded products loses? There, it's much more important to understand the dynamics and see how the two segments of the markets interact. And the way to do that is, of course, with differentiated price increases, understanding and affecting the price elasticity of products. You can, in principle, and you need to really assess if that investment makes sense, build brand value to become less elastic, which is, of course, a large advantage in the competition. Build, where possible, a larger portfolio so that also reduces your elasticity, because more customers switch within your portfolio than between portfolios. Also, the same is true for promotions. We see in cases with a large share of private labels also an increase in promotion. And here again, if there's lots of interdependence, that's something to consider using in the fight, essentially against private labels. If the own sales and the private label sales are largely independent, then of course the promotion needs to make sense for itself, regardless of its effect, more or less regardless of its effect on private labels. And also, we didn't show that here, but you can also use the solution with regards to the trade terms. So you can fully implement the trade terms that you have and use it to understand also what the dynamics look like from a retailer's point of view, where the retailer, of course, has a difference in what share the retailer gets for private labels versus the branded products. And this is something with the solution that I just highlighted, you can do in detail. And just to conclude, so from what we see, there we rarely really see a silver bullet where just one trick saves the day. But what we see essentially all the time is that improving the own revenue management, particularly also in relationship to the private labels, are many small improvements, understanding the specifics, the dynamics, and then working properly with it, making differentiated price changes where it makes sense, increasing or decreasing the portfolio where it makes sense, and really working with the details and having a detailed understanding of the dynamics in the market or in the category. Paul?
All right. Thanks, Ingo, for a super insightful webinar on private labels. I saw a lot of engagement also in the chat here. Someone already asked in the direct chat if they can get the deck. So just wanted to remind or to raise that we will send the deck and the webinar recording to everyone on Monday. So please check your inboxes for that with your registered email. And then someone else was asking about the solution. The idea and simulation is clear, love it, and big thanks. The question is how to use the simulation for a new product launch or distribution channel management. And I answered that this is indeed possible. You know, in the very simple version that you showcased first, obviously, we just wanted to focus on the concept in terms of, you know, a very simple price and private label and premium product case. But in the real market, it's much more complex than that. And that's really where the strength of something like Buynomics lies. We've shown this in other webinars, but we can also simulate, you know, new product launches and also look at this on a channel customer level. So happy to show you more if you want. I left my email and also my LinkedIn in the chat here. I think that was it in terms of questions. If you want to learn more, yeah, just connect on LinkedIn and send us emails. Jonathan also kindly reminded us that we have, and we can maybe show this on the next slide here, we have a new format coming up. So we will have Buynomics Talks with our first guest speaker next week, Frank Buchler. We'll discuss democratizing pricing research. You can register for that. You'll also get a reminder in your inbox as well. So please join and feedback if that's the format that you would like to see more of. Obviously, Ingo's presentation was super insightful. We just want to kind of diversify a little bit our formats to have more fireside chat types of presentations. So join that and please let us know if that's interesting and insightful for you. And our next Buynomics only webinar, so to say, will be in 2 weeks as usual on pricing tools, how they've evolved from a pen and pencil era to you know, the future of SaaS, and yeah, hope to see you there as well. Jonathan also posted the link for that, so please check that out and register right now if you're interested. Yeah, thanks everyone. Thanks Ingo for this great webinar. And yeah, let's be in touch if you have any questions, and otherwise we'll see you at the next one.
Thanks. Have a great weekend.
Thanks everyone. Bye.
Bye.